Hi, everybody. Thanks for joining in. My name is Robert Faroknia. I'm faculty at Columbia Business and Engineering School. I'm also the founding executive director of our initiative on fintech, officially entitled Advanced Projects and Applied Research in Fintech. It is my delight to invite you and welcome you to the Second Annual TalkIQ program, which is a series of moderated fireside chats with women business leaders in finance, technology, venture capital, and private equity. It is also my special privilege to launch our 2023 program with Rebecca Kaden from Riskreward Ventures. And so what our plan for the next hour is to have a moderated conversation around a lot of topics around venture investing, the state of the world, startups, careers in venture, and on and on. Please note that this conversation is being recorded and will be made available to attendees and registrants later on. And we'll be taking questions throughout the conversation, so feel free to submit your questions anytime through the Q&A function of Zoom, and we'll be monitoring them and incorporating them in the conversation. Now, quick background in terms of our esteemed guest. So Rebecca is a managing partner at Riskreward Ventures, one of the marquee venture capital firms in New York, with a portfolio and investment history that's enviable for many decades. She's a graduate of Harvard and Stanford, actually, MBA, and now she's at Columbia with us. And she started her career as a journalist and eventually made the transition to venture, and which is something I'm quite keen on chatting about. So, Rebecca, welcome. Thanks so much for giving us your time and being with us today.
Thank you so much for having me. This is fun. Excellent.
So my first question, which I'll always like to ask in these conversations, is about the state of the union, if you will, of the venture world and investment world. Obviously, the last year or so has been quite interesting and adventurous. We had markets convulsing one way or the other, a series of unpredictable, perhaps, or at least unforeseen outcomes like the collapse of Silicon Valley Bank, rising interest rates, and on and on. So give us the state of the union, if you will, of how you see the world and where we could potentially go from here.
I mean, I think we're at an unusual and both highly unstable and also pretty interesting time in investing. To your point, you know, we saw very shaky markets, valuations completely reset, the collapse of the kind of central bank of venture capital, which, you know, many didn't believe really could happen, rising interest rates, changing prices, the, you know, dramatic kind of collapse of a lot of crypto, all of these kind of things are going on. And yet we have, you know, massive layoffs at fundamental platforms that have captured a lot of talent, which both creates new talent for startups hiring in the ecosystem and a flood of people, sometimes with a lot of severance, who are interested in starting companies. We have the evolution of AI, which, you know, was slowly and then suddenly in many ways, which is potentially the greatest platform shift that we've seen, if it is a platform at all, and has so many more questions and answers to it right now, right? A flood of opportunity to be built on top, and also many, many questions about where the value is going to accrue, where it should accrue, the questions we have to ask ourselves about what we want to build on it and should we be building on it, you know, the role of platforms and nonprofits versus for-profits in it, all of these major questions, which are somewhat unprecedented to the last era, I think, of platform shifts in tech. So it's a very complicated time, I think. You know, there's a lot of ambiguity, but there's also a huge amount of opportunity, both in, you know, what can be built and the amount of talent coming into the ecosystem.
Excellent. Now let's parse that out a little bit. So how do you, obviously the work of a venture capital is quite interesting. On one hand, you have to kind of foresee the future 7 to 10 years out, but at the same token, you have to respond to market realities as they're happening today. So how do you see in the short term, perhaps next 12 to 18 months, the kind of this shakeout continuing? How much further valuations have to go down before they kind of reach the kind of plateau, or perhaps a trough? There are a lot of companies sitting on the sidelines, even those who are not doing too bad, waiting for IPO markets to come back up, and who knows when that's going to be. And obviously, you've been in this business long enough to remember prior cycles.
Yeah.
So compared to those prior, ups and downs, how do you perhaps, what scenarios could play out, and how do you foresee them playing out in the next, in the short term?
Yeah, I mean, the job, to your point, our job is to predict 7 to 10 years out. I think in some ways, we are better at that than predicting the next 12, 24 months of an economic cycle. I think there is plenty of evidence to believe venture capitalists have made pretty terrible economists. And so I don't know, right? My belief is that we have not seen the bottom of the market evaluations, that the general instability and ambiguity is creating continued questions, but that it's also quite bifurcated, right? That you're seeing the bar of what it takes to raise significant capital, certainly at significant prices, rise because of this general uncertainty in the market. And yet new technologies on the AI side are flying off the shelf at very high prices. And that's not that unusual that there's bifurcation in the market, right? That some places are very shaky and uncertain, and some places are very hot and are aggregating capital to it. The seed market actually is still quite hot. Your Y Combinator, which is it's an oddball, and it's also sometimes a little bit of a barometer, just because it's large, and they have their demo day this next week, and prices are very high. There's a lot of money in seed. Why is that? People are hesitant at the A and the B because of that uncertainty you're talking about, so they're flocking to the earlier stages. So there's just a lot of complexity. I think what we feel good about, or what we're talking about, is that 7 to 10 years out, where in this AI development do we want to be focusing our thesis? What parts of our existing thesis around network effects and broadening access are we most excited about right now? And we want to take advantage of the talent in the ecosystem, and, to be honest, some of the pricing in the ecosystem, to make investments in. That, I think there's a lot to be optimistic about. The next 12, 24 months, I think we believe is likely to continue to be quite shaky.
Well, I appreciate your candor in this regard, but also, so how do you spend about your time now in terms of catering to existing portfolio companies and ensuring they are being guided as steadily as one could in this environment, and then continuing with the mission of identifying next best companies in a series of domains, all those domains that as a firm you guys focus on?
I mean, truthfully, we're doing both of those things in any market. At the top of the market, there's capital flying. You're having to make decisions as a portfolio. There are the haves and have-nots in a portfolio. There's its own kind of set of complexities. In a more complicated market, you're looking at runway and burn rates and where the opportunity is going to be. The one thing to note is this cycle wasn't unforeseen, right? In some ways, it was foreseen for quite a long time. A lot of people, predicted it enough that they couldn't be wrong when it actually happened, because they'd said it so many times, right? And again, none of us knew the timing, but we, as a firm, for the last kind of 2 years, have been encouraging companies to raise early. We spent a lot of the kind of last quarter of 2021 funding the portfolio. So we are not finding that a huge number of our companies are imminently running out of money. Many of them are quite well funded. There was a lot of capital in the market, and that's still kind of working its way through the system. What we're spending a lot of time with them on is priorities have changed. You have a market that was valuing growth at all costs and this like top line acceleration, and now is saying unit economics and path to profitability. And that's sometimes a really hard switch to make for founders, and how to think about how to prioritize running this company and what's going to be valued by any investor, whether it's, the Series B or the Series A or the public markets, and trying to help them stay abreast of that and make those decisions, and also take advantage of where there's opportunity in the market is something we're spending a lot of time on. And then we're doing our business. We're making new investments. USV's pace remains relatively steady because we are not high velocity investors, right? Every firm has a different strategy. Ours is to be relatively low velocity, high conviction. Each partner is going to lead 1 to 3 investments a year. That should not change very much. in economic cycles. And so we're very much still doing that.
Well, based on your response, two follow-ups. You alluded to a point that has been quite important, which I share with my students, and that is, vast majority of entrepreneurs that came of age in the last decade or two have been kind of brought up in an environment of zero interest rates and generally, rising markets for the most part and on. But now all of a sudden, it seems like you're back in March 2000 in a sense of shift that you alluded to in regard to how you operate a business. What are the best practices you can share you have seen in entrepreneurs or CEOs of portfolio companies who were able to make that shift successfully, and what are the things they're focusing on now that are managing the business in this distressed economic environment, but also keeping an eye out on growth and the big ball, if you will?
One of my observations in here that I find interesting is in the boom time, before this market reset, it wasn't like every entrepreneur was having money thrown at them and was just, accumulating capital and growth at all costs, but a bucket of them were. And then, so in our portfolio, I kind of group it into different slices. With any early stage portfolio, you're gonna have one slice where companies aren't working and, probably won't. That is what it is in any environment. You have another slice where it's just too soon to tell, right? That's a big chunk for us. Then you have a slice all the way on the other end that had money being thrown at them, that you would talk to them on a Saturday and they'd say, hey, blah, blah, blah firm called and they want to put $100 million into the round and they'll close on Tuesday. And you were like, okay, that's relatively non-dilutive capital. It's going to give you all this runway. And they learn to operate a business as if that was the norm, right? A lot of capital, a lot of resources, a lot of time. But then you had this other group that had promising businesses that we really believed in and never was able to resonate with the market that well. It was always hard to raise money. And ironically, that group is doing great right now because they've always ran their business like capital was hard to come by and like you were never going to be promised that next round and you had to overperform. One interesting thing to me is that overweights diverse founders who never had the money thrown at them in the boom time where there was a lot of founder kind of pattern recognition. We have some founders now with really, really good businesses that are, have really strong unit economics that are like, this environment looks a lot like how I've always run this business, let's go. And they're somewhat advantaged in doing so. For the founders that have these, high flying companies that had attracted a lot of capital, I think what's differentiating the ones who can kind of pivot mindset and not is speed of learning. If it takes a long time to reset that and to read the cycles and they rely on the idea that they just have a lot of money in the bank, it doesn't look so good. If they built a culture around fast cycles where they're taking input and making changes quickly, then they're able to pivot to new norms pretty fast and look at the capital that they have as a war chest and a safety net, but not a time elongator where it's like, let's just go slowly because we can. So like with many things, I think speed of cycles is a huge differentiation in quality of team.
This question of diversity is something I definitely want to come back to because not only of personal interest and the purpose of TalkIQ, but also audience questions. You alluded to velocity of investment at Riskreward Ventures, and then now you talked about the speed of cycles. Give us a bit more color how you adjust those, if at all, given the kind of external factors that you can't control, economic cycles, or all of a sudden the velocity of development in generative AI that took a lot of people by surprise. So how do you pivot, if you will, your role in responding to these externalities, good or bad?
How do we pivot our own speed and our own velocity?
That's right.
Yeah. So as I said, USV from an investing cadence point of view should be relatively stable. We sped up a little bit in 2021, as did everyone else, but we prefer not to. 1 to 3 investments per partner per year. The 6 investing partners manage 3 pools of capital: a core fund, which does seed and Series A, an opportunity fund, which does opportunistic later stage investing, both in the portfolio and not, and a climate fund, right? So that's a fair number of strategies for 6 investors to manage. And we each should kind of lead 1 to 3 investments a year. That does not change a lot with economic cycles because it's purposely constrained, right? Like there should be way more opportunities than that we're interested in, and we purposely constrain it. Why do we do that? We believe that raises our bar and quality of thought, and we've structured funds that we should never have to take a top-down approach. And by that, I mean, if you have a huge amount of capital, and some funds do this and do it quite well, but if you decide that your strategy is to have a huge amount of capital, then you have to be in X number of great investments. Otherwise, just the math doesn't work, right? You won't return the fund, let alone multiply it. We don't raise huge funds relative to our industry and our market. And the reason is we always want to take a bottom-up approach. We always want to believe that there are many great companies in the world started every year that we won't be in. And that's okay, as long as enough of the ones that we decide to invest in and decide to work with us succeed. And that allows us to be thesis-driven, take time to think, develop hypotheses and theses. So when the world is moving quickly, as it is right now, if you take AI for an example, we just had our internal meeting. It wasn't on any deal. It wasn't on any opportunity. It was a thesis-driven meeting on what we care about and what we're interested in the category. And if things pass us by while we're developing that perspective, we're okay with that, because we think the quality of that perspective is going to make us much better when we do deploy capital against it versus having to kind of rush and do the first things we see. In general, with cycles and platform shifts, we don't find that the first ones out of the gate are the strongest. That might be different here. There's a lot of different things about this, but that the more we can hone the perspective and find alignment, the better we're going to do versus rushing to be first.
Certainly, Fred Wilson, partner at the firm, had an interesting blog post on how he passed on investing in Airbnb, which I always have my students read as a great case study in a way. And that's what you mentioned right now. It's something I certainly appreciate, intellectual honesty, integrity, when I put my academic hat on when it comes to developing and updating your investment thesis as a firm. As a matter of fact, that's another question I wanted to ask you, also questions from audience members. How, in light of what has conspired the last year or two, kind of investment thesis 3.0 of USV has changed, if at all? And what are the things on your horizon you're paying close attention to as you're further refining your investment thesis going forward?
Yeah, so USV has published 3 kind of horizontal investment theses in the history of the firm. When we publish them, they're often more a reflection of us realizing that that's what we're already doing and it needs to be articulated than that saying, here's what we're now going to do. And then underneath, we're constantly iterating on the sub-theses. How does that thesis apply to different markets or different areas or different shifts? And that's really where we are today. You know, thesis 3.0, which is about leveraging platforms and networks to broaden access, we actually think has only gotten more applicable over time versus less. And maybe the shifts in the market will dictate a new thesis, but actually right now we think it's just kind of hammering the thesis we have and forcing us to define it in new ways under it. You know, one exercise we're doing is we are looking through the entire portfolio. One question about AI, for instance, right, is who the main beneficiary in early days is going to be. Is it going to be new entrants, or is it going to be incumbents that can leverage technology in interesting ways? Like many things, the answer will probably be both in different ways, but it's something that we talk about. So a lot of our portfolio is exploring different strategies, and already some of them are doing it in really interesting ways, making use of this tool set and technology. We're spending a bunch of time on that. That's very related to our thesis, right? Like this is an application of our thesis around how networks broaden access. AI may be one of the more, you know, interesting tool sets that drive up value and down cost. It also comes with a lot of complexity, but that very much falls under 3.0. So I don't think we're super close to totally reiterating our thesis, but sometimes it sneaks up to us and we'll see how it goes.
Great. So let me follow up on a related question, especially for those on the call, on the webinar, who might be looking to raise money at some point or have entrepreneurial aspirations. So what kind of heuristics in general do you use, given that as a firm and as a partner, you guys have this bottoms-up approach? You have the privilege of pretty much being so well known that deals and ideas come to you. You don't necessarily have to search for it, but that also it's a bit of a challenge because you have so much, coming at you. So what kind of heuristics do you use to kind of you act as a first or second filter? And what advice would you have for entrepreneurs on the webinar who might be interested in pursuing venture investments sooner rather than later?
Yeah, so I would say the thesis is our first kind of level of defense heuristic, right? That it's as much, it dictates both what we do and what we don't do. And it allows us to say to ourselves when we see things, even interesting things, is this for us? That's really what venture has this kind of reputation, and I think sometimes it's done this way, where the idea is that you're meeting lots of different founders, lots of different companies, and in these really constrained periods of time, you're supposed to meet a founder and say, is this business good? And I think USV and I never have liked that idea. It's in some ways a ridiculous idea, right? It's someone who's spending their life working on something, and I'm going to spend 30 minutes and try to tell you if it's good. That doesn't really make any sense. What we can do is say, is there alignment? We have a set of interests and ideas. We try to publish them as much as possible, both that broad horizontal thesis and then sub-theses, the intersection of AI and learning, or networks and access to healthcare in interesting ways, or enabling infrastructure that allows marketplaces to be built on top, or whatever it is, right? And we try to publish our ideas, and there's many others that we haven't gotten around to publishing yet. And so the first idea is there just alignment? Can we have a conversation that says you're building something, is how you're thinking about something, one, in the zone of something we're focused on, and two, aligned with how we're thinking about it. If it is, I think the second heuristic is around, for me, is a lot around the founder and the team. Because these ideas are kind of by definition very early, whether you're a seed or a Series A. We all know that the idea itself is only going to get you pretty, just a little bit of the way there. And that execution and that ability of the team is really the differentiating factor. So I think a lot about that. Can the founder recruit exceptional talent? Is there reason to believe that they can bring people on board in any capacity, that you're like, wow, how did you get them involved right now? That they're just going to be a talent magnet and attract capability around them. That's a big one for me. The second is a product mindset. Generally in markets, there's multiple ways to attack them. There's sometimes more financial ways and more product-driven ways, or more services-driven ways and more product-driven ways. USV as a firm really gravitate towards product-driven founders and product-driven approaches. So that's one that we look for. Another is, I think a lot about thinking at multiple levels. Is it a founder that can tell this compelling story, which they're going to have to do over and over, to people they're recruiting, to customers, to partnerships, to the press, to potential acquirers, over and over and over? Can they do that in a super compelling way? And can they also live at the detail level where they can really operate and understand at the kind of nitty gritty place? That's very hard to do. And is that an inherent skill? So the second one is really understanding the team that you're working with to attack the problem.
And a quick follow-up: to what extent validation of an early stage idea is viewed within the firm? Obviously, companies tend to pivot, but at least to what extent? What's the minimum threshold of validation you might need?
Yeah, I mean, the frustrating answer to that question is always, it depends. And it depends on a couple of different things. One, it depends on the round it's being raised, right? If you're coming and saying, I'm raising a Series A, I'm raising a Series B, we're going to want to see more proof points and validation. At a seed, if it's the earlier it is, the more likely it is a fit for us if it's very close to a thesis area that we've articulated. If it's not, if it's adjacent or it's interesting, but it's not kind of the middle, we're more likely to want to see more proof points. So it a little bit it depends on how close it is to our core, and what questions we have that we believe time de-risks.
Great. Now, let me shift slightly to some of the notions that you brought up in terms of thesis or fit. And I want to dig deeper a little bit around a couple of subdomains. I'll be remiss if I don't ask about fintech, since I'm leading the Fintech Innovation at Columbia, and I'll be launching a brand new course in June on the future of finance with our exec ed team. So obviously, fintech, I have a broad definition for it. Includes everything from crypto to classic finance and so on. What subdomains within fintech do you view more favorably now? And what areas do you feel like they could potentially benefit disproportionately well from the application of AI?
Fintech has always been a core to us. As you know, the fintech market has really gotten rocked in the last 12 or 18 months. There's pieces of it we are still very excited about. Crypto and Web3 is a core thesis of USV. It has a lot less to do with speculation in crypto than it has to do with decentralization and the role of the blockchain as the first really viable technology towards decentralization. We believe decentralization has a lot of very positive and necessary impacts for technology, for innovation, and for financial services as an application of it. So it's still something that we are investing quite actively in and are big believers in. I have spent a lot of time on consumer fintech. I actually think it's gotten harder, largely from the acquisition side, but there's still a huge amount of opportunity in it. Big believer that the credit system in this country is very fundamentally broken, and we're interested in things that are looking to solve that and work on that in different ways. Overall in fintech, we've been interested in applications that enable access, so create value and lower costs structurally. We have not been interested in what we call kind of luxury in fintech, how you help kind of rich people get richer. There's a bunch of that. Some of that is good businesses, not our thing, but there's still a huge amount of opportunity in the how do you broaden access to financial services, which is pretty fundamentally broken for us. The big caveat there is we're interested in how to do it in advantaged acquisition ways. I think the era of being able to buy the customer online is almost over. The economics that we've seen just don't foot. And so we're interested in where are there kind of advantage channels or approaches to building these applications without just, huge marketing spends along the way, which tend not to be the fit. There's also a lot of B2B opportunity, I think, in fintech. I think as so much of the payment ecosystem has moved online, many of the consumer tools are not yet applied to the B2B applications, and we've been looking a lot at that. We've made some investments there like Slope and others that have done really well, and so that's a category we're interested in. So we're spending a lot of time there, but sensitive to the economics that go with it.
So in essence, perhaps those business lines that have a cost of funding issue, let's say buy now, pay later, are less of an interest given what's going on in the world, whereas applications where you might have inherent advantage. Let's say you're a property casualty, insurance company, you have amazing data, and now you're always deploying it for a variety of reasons for customer acquisition. Those will certainly more of interest. Am I right in those assumptions or those examples?
Don't know enough about the examples, but yes, advantage channels or applications that have kind of advantage to go to markets is something we're thinking a lot about.
Well, as someone whose main focus of research in fintech is on household finance, especially distressed household finance, not only I couldn't agree with you more about our kind of a broken system, but I also wanted to express my gratitude for you empowering entrepreneurs who are truly passionate about tackling some of these issues. And certainly, at my lab, you're looking at a lot of those solutions as well.
Good.
You brought up a point. I love to dig a little bit deeper because I think it's quite important for those interested in venture in general and fintech in particular to pay attention to, and that customer acquisition costs. Indeed, I agree. Long gone are the days you could just throw gobs of money at online marketing and acquire customers. Now it's become much harder, obviously more expensive, and the economics don't make sense. So what are the more creative ways? What are the things that you have seen perhaps in some existing portfolio companies or kind of mental models in general that you think would be worth paying attention to in terms of creatively and cost effectively acquiring customers where there's just so much competition for them?
Yeah, what I mean by that is look, the iOS switches, the Facebook algorithm switches were really big changes for any application market, right? And it structurally changed the cost. And there was a pretty long era where you could pour capital into a single channel and somewhat reliably know what you got out. And that is not where we are. And so what we're seeing is you need to find viral loops and organic forms of growth, products that work better by bringing others in with you. And so there is a reason that it grows inherently, product-led growth, where the product can drive its own scale, or really dynamic marketing through channel partnerships, through, the creator economy is interesting, different kind of elements, but I just don't think we're in a silver bullet era. And as I have done a bunch of consumer investing and I'm interested in it, and we all love, silver bullet eras because they're a lot simpler, but in some ways it's more interesting when we're not at that, but it puts the quality of the team and the ability to maneuver quickly at a much kind of higher regard in the company.
The threshold of difficulty has gone up, but also at the same token, there's just more room to experiment in a way.
Exactly.
And certainly as a firm, one of the core investment theses of USV in the past and prior investments have been in, marketplaces, network, things that have network effects and so on. But the challenge in fintech is that typically there are very few applications that ever go viral. There's something about finance that people certainly I don't know who on the webinar enjoys looking at their bills and processing their finances. So how do entrepreneurs can break some of these inherent vicious cycle that, few things can go viral and you can't throw a lot of money at it. So how do you advocate for this kind of measured or disciplined growth, as you mentioned, finding your niche and ensuring you can acquire customers organically and cheaply?
I mean, I think there's a couple, the people who answer that will build very big companies. And so I do not claim to know the answer to that question in its entirety. I think it is hard for viral word of mouth growth in fintech. I don't think it's impossible. I do think there are social loops we have seen and products that people will talk about, and some fintech products that don't look like fintech. I think that's the other thing that we're seeing kind of across categories, that things that may look more social or content oriented or something else, but have a fintech layer to it, may lend itself better towards viral and organic growth. I also think there are other channels. I don't think the task is just you have to build something that you put no marketing dollars against. They just have to be efficient. I think new channel partnerships and kind of ecosystem growth is interesting. There's I think the creator economy is interesting. I think SEO is still really interesting for a lot of companies when done really well. It's not that you can't spend any dollars against marketing. They just have to be dynamic and the economics have to be there. And the last era of consumer fintech was largely driven through putting money against Facebook and Google, and that's not paying back right now. So it's not that you can't market, it's just that the efficiency has evolved.
And you have to be more creative. So I look forward to see how all that evolves. Now, audience question, which I found intriguing, was that obviously a lot of people are in the media focusing on the negative side of the collapse of Silicon Valley Bank, which certainly was a seminal moment for the industry. And I love the way you put it as a central bank to venture world. Now, what opportunities do you think could arise from the collapse of Silicon Valley Bank, specifically around fintech startups?
I think the collapse of Silicon Valley Bank is really unfortunate. SVB played an enormous role in this ecosystem. It supported entrepreneurs who didn't have traditional forms of credit, didn't have traditional backgrounds, and really put a lot of belief into this market and the community that came along with it. And so I don't even think we've seen all the kind of secondary and tertiary effects from it. I think it's super unfortunate. What holes does it leave? The holes it leaves are hard for startups to fill. They're not impossible, and there will be some. We're seeing tons of treasury management startups come out, and I think there's a newfound attention on treasury management for companies, early stage companies overall. That's probably good. I don't know how any of those companies will do. Some of the new startup banking platforms have obviously seen a lot of growth from this evolution and been able to acquire customers. That might be interesting. There's obviously a big hole in the market on the debt side. Credit has played a big role in the startup ecosystem, and SVB really owned that. And it's not yet totally clear who wants to pick that up from a business point of view, from other banks. That will emerge. Maybe it'll get fragmented. So There are opportunities there. I'm not sure how many will accrue to the kind of startup sector.
So in your view, how much further valuations will have to drop? I mean, we're seeing two types of companies, those that are kind of take a big valuation cut in just one swoop, those who try to do it step by step, or perhaps taking on venture debt first. But that's obviously, if you're not generating free cash flow, servicing that debt becomes a challenge. So what advice would you have what for entrepreneurs on the call who might be facing distressed kind of company financial management? But also, how much further do you think valuations will have to go down before we reach a trough?
I'm not sure this is a blip or a trough. I actually think it's a market reset. I think the valuations were out of line with what was really going to be possible from an outcome perspective. So I think we're seeing both this kind of market moment and this kind of systemic reset, and it's a little bit hard to separate the two because they're kind of intertwined. And I don't think we've hit the bottom, and it's also not consistent. You know, as we talked about at the beginning, I think seed is still expensive. There's a lot of seeds getting done at big prices, not all of them, but some. Certain categories are still very expensive. And then much of A and certainly B, valuations have come down a lot because the expectation of where you are with the capital, you're seeing those valued at multiples. Multiples weren't even part of the conversation, right? 18 months ago. And so it's just like, it feels to founders like a little bit of a bait and a switch. They're like, multiples? We weren't told we needed multiples. And so that I don't think we've seen the end of, because as public market multiples shift, right now, private market multiples are shifting with it. So I don't know. I don't know that we're so close to that. For founders dealing with it, I would say capitalize the business when you can. I think the quicker you can change your mindset to the market we're in versus the market we were in, the way better that it does. The founders that are really struggling and trying to hold on to, it's great that you had less dilution in a previous round, but we have to live in the reality we're in. And we're spending a lot of time talking to our companies about that, because there's a lot of founders that are like, well, we want to wait it out, right? We want to wait it out to let this kind of time pass so we can raise back at bigger prices. No one knows when that's going to be. It's not clear to me that next April is going to be better than this April. And if that's the case, finance the business now. And so I'm actually not sure right now is that bad of a time to finance a business. We're actually seeing some interesting things happen. And so I think that's one piece of advice. And two, I think this focus on unit economics is really real, and paying attention to that much earlier than you would have serves you very well.
So let me ask you kind of a first principle question. And that is, for the past pretty much 20 plus years, more or less, we have been in the era of very low interest rates. And maybe there is a secular shift now, a permanent secular shift. And obviously interest rates and general pricing around credit will have an impact on risk reward dynamics in venture investing. But now that whole entire era might be over. How do you see that interplay between risk reward in venture investing and how returns in the future might look like?
Yeah, I mean, I think it's this really interesting question. And we've been talking about that quite a bit internally, and where it presses you, and we're not the only ones in the market, and that relates to the seed comment, is to go earlier, right? Where the risk is high. It's to take more risk. Ultimately, if you go down that road, you get towards, we should take more risk, right? That the way that venture is going to work at its best is to increase the risk and increase the quality of thought and perspective that's going into taking the risk. We're doing that, and we're spending time on that, but we're also trying to think there are opportunities in A's and B's that were mispriced, and that may have some fruit for us too, if we pick right. So the two summaries to your question, I think, are to increase the risk and to increase the sharpness of our own thinking. That it is a time to be less broad and less opportunistic and more focused on our own hypotheses and thesis and where we want to play.
Would that create FOMO in a way? Because as you said, there's a lot of firms that are kind of migrating into our earlier and earlier stage investments. Some of these firms have billions of dollars to deploy. Whereas, USV has been known to have this very disciplined approach to investing, not raising mega funds and so on. How could that would that create a sort of frenzy that, we saw in prior cycles? Or do you think there's still room for finding good ventures at good prices?
I think there's always room for it. Like if you're focused and I think one of the things USV has done well, and I have learned from my partners here and benefited from, is that we don't feel a lot of FOMO in the market. And that's partly because of fund size and the structure. We don't need to be in everything. We want to be in the things that are right for us. And if that's the case, we're in an incredible time of technology and innovation. There is no lack of innovation. Market shift, economic dynamic shift, cost of capital shifts, but fundamentally, the ability to build amazing new things right now and products that are going to change how we live and is better than it's ever been. And if that's the case, there is plenty of venture opportunity.
Well, let me ask you one last question before we switch to different type of a conversation around careers and diversity in the domain. As you can imagine, I'm getting a lot of questions around your views on AI in general. Obviously, it's the hot topic, and the pace of innovation is astoundingly fast. And there are applications in fintech, in education, and on and on. Do you have can you share kind of a general view about this, especially as it pertains to innovation and venture opportunities, especially for entrepreneurs or investment opportunities?
I think I and USV have evolving views here. I think the opportunity is fundamental and applicable to almost every category that we invest in and that is out there, right? It's effectively, computers have been hard to use, and now we've taught computers how to use computers, right? And what that unlocks is huge and fundamental, right? From an efficiency point of view, from an access point of view, and then almost every piece of that has two sides of a coin, where there's massive opportunity and there's massive threat. And the problem with the threat is that we don't know the extent of it, right? It's uncontrolled threat versus controlled threat. And so we are spending a lot of time thinking about that and talking to people and trying to understand how to invest given that reality of this market. I think many of you probably saw that letter asking for the 6-month pause on AI development. We don't know if that's the right, answer or not, probably not exactly, but I don't think it's one where it's not mobile, right? Where you just can throw a lot of money at it and kind of see what happens. I think it's pretty complicated, but also, if I've been spending a lot of time in the intersection of AI and learning. Lots of questions and complexities, lots of problems that it could arise for teachers and for students, but also that ability to make one-on-one education much more accessible at a totally different cost curve is like nothing we've seen. And that totally changes education. But that doesn't negate the questions that are involved in it. And so we are taking our time and spending time on that with different categories, and also thinking about, from the model point of view, how do you invest in making the models intent positive? And that's a big, hairy question. So we have more questions than answers right now, but I think this is going to be the kind of fundamental category of our decade.
Now let me switch to questions on the career side in general, and venture, especially in New York. So part of the benefits of running webinars on TalkIQ is that I can bring in speakers both from New York and Silicon Valley. And I had the pleasure of having Fred in my class a number of years ago, and he was half jokingly telling the story that being a venture capitalist in New York meant that you get on the plane on a Monday, go to Silicon Valley, come back on Thursday, and you call yourself a New York-based venture capitalist. Obviously, the world has changed. We have a lot more firms, thankfully a bit more diversity. We still have a long way to go. So how do you view venture capital community in New York City in general? And what are the core advantages that Silicon Valley wouldn't be able to replicate in short order? What are the core areas of strength that entrepreneurs should seek in a venture capital community in New York?
I'm so excited by what's going on in the venture capital community, and more importantly and related, the entrepreneurial community in New York. did venture for 6 years living in San Francisco, and I've done it for almost six and a bit years living in New York. The pandemic kind of structurally changed a lot of things. And one was when people believe they can live where they want to live, New York is a pretty great place to live, right? People love it. And that's just that fact alone has brought a huge amount of talent here. And we're seeing the benefits of it. But I think we're also at a point in time in the application layer of development that there's a lot of industry intersection, right? Where a lot of the most interesting things going on are about the intersection of technology and financial services, or technology and healthcare, or technology and retail, or whatever it is. And New York really is a great place for that, because industries collide and people thinking about things collide here in a much different way. And I think we're seeing the benefit of it. So we've seen a huge number of portfolio company CEOs move to New York, talent move to New York, companies we're looking at exist in New York. There's more infrastructure being built around it here. So, I definitely think the era of, I have plenty of boards in San Francisco, so I'm there a lot, but the era where you had to, get on the plane to do this job is not where we are.
You alluded to your own career. Certainly, it's an atypical career for most people when they hear it, a journalist turning into a venture capitalist. And it's just so interesting to me as someone who's on the board of a Knight Badger Fellow program at Columbia Journalism School, that there are actually some really amazing and super senior investment professionals in private equity and venture capital who come from kind of a journalistic background. So take us through a quick journey about your own career and what made you switch to venture, how venture now it's different, and what advice would you have for those who have aspirations to join venture capital as professionals? What additional talent, characteristics, or ways of operating do you advocate for them to learn and apply to become successful in this new era?
Yeah, I always start this by saying venture capital is a word that means a lot of different things at a lot of different stages, right? Being a growth stage investor is very different than being an early stage investor, would require different kind of initial skill set coming in. So I can only speak about what I've done, which is predominantly early stage investing. I've always been at firms that are kind of seed and series A focused. One of my favorite parts of venture and the landscape, given that, is that there is not a set path. It is not a career or a role where you have to have done X to lead to Y. There are people who started companies, there are people who worked at companies, there are people who worked in more traditional finance jobs or consultants or whatever. And then there's lots of others. And I think the biggest common theme of success in it is curiosity, optimism, the ability to have structured, repeatable learning, right? To go from interest or intrigue to perspective quickly and in an informed way and in repeat. Because that's what you're doing, right? You're seeing so many different ideas and you're trying to gain perspective in this kind of repeatable way. And that's, I think, the learned skill in this job more than the trades associated with other roles. So that I really value that about it. Journalism has a totally different output, but the ability to form a story with, kind of probably fewer data points than you would like and more than you need is very similar to early stage investing. Getting people to trust you and come to you, very similar to early stage investing, and then lots of differences. So I like the variety.
I appreciate you saying that. Let me add one more layer, and that's on the context of diversity. Earlier on in the webinar, you mentioned that the kind of diverse founders that typically in the past had difficulty raising money now actually are primed because they always had difficulties, so they can manage those well. So we have gone a long way, but still have a long way to go. So as a successful woman in venture and in technology, what advice would you have for the women on the call and the female students on the call who have entrepreneurial aspirations or want to join venture capital in one way or the other for their professional careers?
Yeah, it's been a disappointing few years in that we've kind of gone a long way, but the numbers also suggest that we've gone nowhere. The data around women founders in particularly, and also investors is pretty dismal. We need many, many more. On the investing side, my advice is always to immerse yourself in the industry and start doing it before you have the role. Capital is the commodity part of this, right? There's a lot of places that have capital, but that ability to have perspectives and to pick, right? And then to help that founder, that is the skill. And if you can develop reps in that, it will make getting that job a lot easier. And so immerse yourself in entrepreneurial communities, figure out the value that you can provide to them. You have it. You just have to figure out what it is, and develop that repetition around why do I gravitate to this idea? What am I looking for? What are my heuristics? And then if you start, sending ideas or companies you meet or founders you meet to firms that you admire, oftentimes that is a very good road to lead to that transition to the profession.
Now, in terms of technical skills, the world is getting more complex. Blockchain, crypto, Web 3.0, generative AI, they all require, to understand how they operate, it requires a lot of technical skills. As a venture capitalist, to what extent do you advocate acquiring technical skills, or do you still need to kind of stay above the fray, if you will? Because if you get down to details, you might lose the big picture. Where are you on that argument? Which side of that argument are you on?
I think some great venture capitalists are very technical and many are not. Part of why I value partnership is that you can have different people with different skill sets. For instance, in ours, many of us are not technical. My partner, Albert, is very technical. And when things come up where we have, the most questions there, he's a huge resource. But we each kind of are a different piece of the pie. And that's why partnerships are really valuable. I don't think it's essential. I think the ability to access people who have those skills and knowledge, we talk a lot about being generalists, right? And we hire generalists, not experts, that we believe that when we launched a climate fund, for instance, we didn't go out and hire experts in climate science. We believe that we're learners and we could develop perspective on the area, but we want access to experts who can help us along the way. Think about technical questions similarly. So I think you can have it, you cannot, but you have to figure out how to have access to it.
Keep coming back to that intellectual curiosity you alluded to early on, which I fully endorse. Now, in terms of leadership skills and also best practices in a partnership, what are the can you share some examples in what really works well within USV, given the fact that partners have all different backgrounds, and I'm sure there have been many situations where someone felt strongly about an investment one way or the other versus the rest. Can you share examples of best practices that ensures the smooth operating of that partnership model?
So USV is not long on process. Many firms vote or rank or have these kind of processes for deciding investment decisions. We don't have that. We have a very conversational approach. We run a totally flat firm among the investing partners, and we run a consensus-driven process. So generally there is someone or a few people spearheading it, but we all have to agree to make an investment for it to get done. And we just talk about it until that happens. The thing we rely on is a lot of trust. A lot of time spent with each other, developing hypotheses and theses that we're going to rely on as guides for those decisions. And then a lot of trust where we, believe people's perspectives come from the right places, and they really do. So it is not a place with more process than that. And often to newcomers, it looks like a free-for-all, and yet somehow it works.
Organized chaos in a way.
Yes.
The next question from audience members are about your views about global venture capital or global opportunities for investments. Any particular geography, even though you might not invest, but in general is of interest to you or feel like is ripe for growth and opportunities for investors or entrepreneurs?
We've been spending quite a lot of time in Latin America, particularly in fintech. We now have a somewhat robust portfolio there, and we'll continue to do more. That's probably, our portfolio has always been North America and Europe centric, and Latin America is probably the market we've added to that the most recently that we've kind of gained density in. We aren't a firm that kind of tries something here and try something there. We just take a more focused approach. I believe there's a ton of global opportunity right now, but we tend to kind of focus our efforts.
What has been the best pitch that you have ever seen in your career that stands out in your mind?
Oof. Best pitch I've ever seen in my career. There is not a perfect pitch. The thing I always say about pitches is like, the easiest thing to do is say no, right? Every pitch you see, there's tons of reasons why you should say no. The best ones give you some, inkling of why you should say yes. I think about ones that really, when we heard the JustWorks pitch as an example, that was a little bit later stage company, but it was so aligned with our thinking and our thesis in the category, and that founder was so crisp that we get there very quickly. There are pitches we hear that we just get there very quickly, and pitches that have a lot of debate, but none of them are perfect.
It was more a combination of art and science, and obviously the onus is on the entrepreneurs to do the research with all the content you have on USB site to kind of understand the fit better. I certainly can advocate for that as well. In terms of the fundraising environments, not just for entrepreneurs, but actually for venture capitalists or those who are under Fund One or trying to raise Fund One. Obviously, they don't have the brand name that USB have. You guys can probably raise money by a couple of calls. But for those who don't have that privilege, how do you see fundraising playing out? It's certainly very difficult now. Is that going to do you envision more funds gravitating toward the usual suspects, or will there always be room for new emerging managers?
I think there will always be room for new emerging managers, simply by the fact that emerging managers have tended to outperform, right? The numbers are in your favor. However, I think there was an era where people were raising significant funds without any investing experience. They were just kind of interested in it, or former operators. And I think from what I have heard, and I'm not the closest to it from where I sit, the LPs have moved away from that they're looking for more track record, more experience for emerging managers versus what they were looking for a couple of years ago. But I think venture trends towards hustle. It really does. Like, you said earlier, USB, we can sit and let pitches come. We could, but we may not see the best ones. And that's definitely not our approach. Like, I am a believer that the minute you believe you're the best brand in town, the minute you believe that like you're the king of the castle, that's when that other firm that's starting that has 10x that hustle is going to outpace it and get to that founder first. And so you have to maintain the hustle. And I think venture has rewarded that and continues to.
Last time we spoke, I asked your opinion or sharing of the one seminal book that you, in your entire career has been kind of stands out in your mind. And related to it, there's also a question from the audience in terms of if there has been one particular book that has impacted your ability for the better, obviously, in terms of identifying and investing in great companies. So two book recommendations.
The seminal book for me, before I was in venture, before I thought I was going to do anything like this, I was a Russian literature major and passionate about that, believed that that's probably what I was going to do. And I fell in love with a book called Pale Fire by Vladimir Nabokov, which is really about the power of stories and narratives as central to our lives. And I still think about it all the time. So it is not a business book, but is the guiding one for me. I am not a big business book reader. Some people are, I'm just not, but I'm a big information perspective consumer. But I have found that much more valuable than any book has been, the blogs of my partners and other investors that I admire, discourse on Twitter and other channels, and just kind of being part of as broad conversation as I can, versus kind of, seminal static books.
And certainly, as both, whether you're entrepreneur or investor, the storytelling it's in essence key. At the end of the day, we're all storytellers anyway. Any final word or any advice for the attendees, Rebecca?
Thank you so much for having me. It's fun to get to talk to all of you, and I appreciate you listening.
Well, thank you so much for joining us. On behalf of our entire Columbia Business School community, I'd like to extend to you my deepest gratitude for agreeing and giving us your valuable time and sharing your insight. I also wanted to thank the good folks at Columbia Executive Education team for all their logistical supports and helping bring TalkIQ 2023 to reality. We certainly look forward to having you all for our next TalkIQ happening on April 11th. Information will be sent out soon, and hope you can join us then. So with that, I'll bid you all a good afternoon and a wonderful remainder to your day. And Rebecca, look forward to our future interactions with you as well. Thank you so much,
Thank you so
everybody.
much.
Have a great day. Bye.